And for more analysis of the mining tax, we're joined now by economics correspondent Stephen Long. Stephen, this policy had its genesis in the Henry Tax Review. How much of the original Henry plan remains in what we've got today?
I think it's fair to say virtually nothing, Lee. This bears no relation in terms of the design, the structure, perhaps even the theory to what Ken Henry proposed. It's about as similar to the Henry plan as a hairy-nosed wombat.
Something Ken Henry could no doubt relate to.
Indeed.
The word reform gets bandied about a lot. Does this actually qualify as a reform?
Well, I think that many of the tax experts and tax purists would question whether this amounts to genuine tax reform in a number of ways. When you reform the tax system, you're looking to increase efficiency, equity, and simplify the tax system and broaden the base. Well, in terms of simplifying the tax system, this certainly fails the test. We will now have different tax regimes and different tax rates applying to different resources, 40% for oil and gas, 30% for iron ore and coal, but none for many other commodities, including gold, for example, which has hit record highs in terms of the gold price. You've got to question why those exclusions, why not a comprehensive tax on resources? And so it's a complex structure, and also it's one that has a lot of potential loopholes. And so, yes, I think the tax purists would say this isn't genuine reform. And then you've got the issue that the company tax rate isn't going to be lowered by as much as originally proposed.
Who exactly are the winners and the losers then out of what we're seeing?
Well, the government clearly has had a political win, but they also have had, to an extent, a win on revenue, because they'll still be getting the majority of the revenue.
It's about $10 billion, is that right?
A little bit more, I think, but they're certainly getting the majority of the revenue.
Right.
And the winners, really, though, are the big mining companies, because this will kick in at a higher rate, but they're going to be above that rate, and they always were. But the actual tax rate at 30% is much lower, so they will be paying less tax. And they've got a terrific return on their investment in the sense that they spent, so far, about $7 million, it's reported, on advertising. And they've wiped out, over the next 3 years, $1.5 billion estimated in tax, and much more over the long haul. So over 3 years, they've got a return of more than 200% on their investment in fighting the tax. If only we could get that return on the minerals themselves.
What about this argument that the smaller mining companies haven't been included in this? Is that likely to have any traction?
Well, I think it's true that this is a deal which very much favours the big miners. And the Henry tax proposal, although apparently some of the small miners, many of them, didn't see it that way, but the Henry tax proposal, on paper at least, would have had many benefits for smaller companies, less profitable companies and projects that were more marginal, because the government was actually taking 40% of the risk, and the companies could write off 40% of their costs, fully refundable against the tax when they finally came to pay it, if they came to pay it, and they would get full deductibility. So in theory it should have promoted more marginal projects and suited the less profitable end of the industry. But that regime has been junked. And this is really a proposal that suits the big end of town in terms of the miners. And then the other issue is that, in a sense, it's benefiting the big miners at the expense of nearly all corporations, because instead of having a 28% tax rate, as proposed when the government announced its reforms, they will only have a 29% tax rate.
OK, Stephen Long, now thank you for your take on that. We'll see you next week.
You're welcome.
Thank you.